Let's stay on all of this and more with us. His take on AI, tech, the markets, your money. Chris Verrone, partner and chief market strategist at Strategas. He is one of the top analysts on Wall Street. We are glad to have him. See, we said that so you don't have to.
Very
See,
nice
Chris, so you don't have to put out a tweet and say, I'm actually the best. But do you find this Nvidia stuff a little odd?
Listen, what I find maybe encouraging is that we've taken Nvidia down 15%, and if anything, the market's gotten broader and has acted okay under the surface. I think that's been maybe the most impressive thing of the last 2 or 3 weeks, that you've had this almost rotational weakness where they've hit some of the big weights, but it really hasn't hit the market at large. I mean, if anything, some of the real economy stocks that you would think are probably the benefactors of AI down the road are actually starting to perk up here. So I welcome that message. I think when a stock like Nvidia is down, there's so much narrative fitting after the fact where you start to say, oh, it's down because of this or because of that. I mean, maybe it's crowded positions in weak hands. I mean, the stock was $80.
Maybe it's up too much, right?
The stock was $80 in April. They traded it to 200.
It's made a lot of people multimillionaires. One of the greatest companies in modern history.
We're down 15 off the highs. We're still in a long-term uptrend. Let's see how this responds in the 160, 165 zone. That is major long-term support. I do think, as you noted, the fact that Broadcom is making new highs here is still pretty notable. And in fact, when you look at the rest of the Mag 7, I mean, Apple breaking out here, I think is an important message. Meta and Microsoft trying to rally. The market's not that bad.
I'm going to compare Nvidia to Brad Pitt. I don't think I've ever done that in my life. And the reason I do that is because when you have a star the level of Brad Pitt, everything he does makes news. Yeah. Brad Pitt's eats sandwich, right? That's a headline. And People magazine has like a picture of Brad Pitt eating a peanut butter and jelly sandwich. Nvidia's kind of that way now. They're so big. They're so important. They're in more than 700 ETFs. They're, 8% of the entire S&P 500. Can you blame anybody, including the financial media, maybe you can, for picking up on when Nvidia does something or makes a small amount of news? It's going to be a bigger deal because they are effectively the Brad Pitt of the stock market.
Well, you certainly can't blame people, but what does it reveal? It reveals where the positions are crowded, where maybe the emotion is most heightened. And I think that's been the story with this stock the entire time. What I think people are missing, though, is, like, take, for instance, on Thursday and Friday. You know, Thursday's the big reversal. Nvidia opens up strong post EPS.
We're up 2.5%.
They sell the market pretty hard. Breadth actually was not bad. And then on Friday, you back it up with 10-to-1 advancers decliners on Friday. On, what was a good day, but externally wasn't a great day. 10-to-1 internals versus decliners. That is a market that's broadening out. That's a market that's going to the real economy. And, this is the whole thing with the AI story and Nvidia in particular. If this is going to have benefits beyond just the chip companies, it's time for it to show up elsewhere. So I think a very important 4, 5, 6 weeks here to see if the market can diversify beyond just the big cap techs and into the real economy.
Okay, let's go on that because yesterday the markets popped. The NASDAQ did not close above its 50-day moving average.
You know what has?
Technically, would you have felt better if it did?
Of course, for NASDAQ, but you know what has, what I think is interesting, and this was true even a couple weeks ago, Russell 1000 Value Index was making new highs. Russell 1000 Growth has not. Very different picture than I think the one that we're used to. And think about what's starting to show up here. The move in consumer discretionary the last couple days. I mean, you talked about it from very depressed attitudes. If you look at any of the sentiment work, consumer sentiment is in the, I think, 3rd percentile historically. Actually, that's where you want to be leaning into consumer discretionary and starting to buy those stocks when sentiment is as depressed as it is. I thought the stand that the KRE, regional banks, have put up over the last couple of weeks is important. I think the fact that the home builders have started to show some life here, equally important. I think this is a market getting away from the myopic focus just on AI to a broader message. Hey, the real economy is probably okay.
So that's an interesting take that you referenced home builders and regional banks because they're both very interest rate sensitive. I want to show you a Twitter poll that we put up last week.
Sure.
Okay, so we showed this already, but we asked our viewers, what's going to be the most important thing for the market the next couple of months? Rate cuts, the macroeconomy, this tariff ruling from the Supreme Court, or AI spending? I really assumed, Chris, that AI spending would not only be the number one choice, but with a bullet, like way above everything else. Man, I was wrong. I was the wrongest of the wrong. Fed rate cuts. 32% of our respondents said Fed rate cuts. Would you agree with that?
I would. And you know what's interesting is, all this attention the last 4 or 5 weeks of, is the Fed going to miss the December meeting? What does that mean for the economy? If you look out looking at, say, June Fed Fund futures or even next December Fed Fund futures, so 6 months or a year from now, they really never move that much. They've been hanging out in this 3.25 neighborhood. So whether December was live or not live, we think it is. I do think they cut. I think the market has finally started to move there. But whether it was or it wasn't, June 2026 Fed Fund futures really never move that much. I think we're on an easing trajectory, and we shouldn't forget that. Brian, the other thing, I was doing some work this morning that I don't want to forget. If you look at how some of the great bubbles have ended, whether it was Nikkei in '89 or even tech in '99, 2000. I mean, in '89, JGB yields went from 4.5 to 8.
Japanese government bonds.
Went from 4.5 to 8.5, right? In '99, 2000, U.S. 10-year yields went from 4 to 6. These typically don't end with the Fed cutting and rates lower. I think it's a really important distinction from, say, today to what we saw in those prior two episodes.
I like